The Finance Act was assented on 29th June by the President. And then on 30th, it's when it was gazetted. This was on a Wednesday. And it brought about a raft of changes to the Income Tax Act, the VAT, the Excise Act, the tax procedures. Also, there are some miscellaneous, some changes on the Miscellaneous Fees and Levies Act. So, when we are looking at this, usually you'll find there are many contributors to what actually will form or make a basis of the changes that you'll see through the Finance Act. In this case, you'll see from the Finance Bill coming in early, people having to put changes that are, or several drivers that contribute to its being. As a Finance Bill to that stage, there is the level where they encourage public participation, and you will see currently the projection. This actually relates to the budget. They are released maybe by March. You'll be having the budget estimates out. These are actually the biggest contributors that shape how the Finance Act will be. And if you are to compare this year, we as a country have an ambitious budget. That is we have a budget expenditure of around 3.6 trillion. And we are expected, rather we are having a revenue target of around 1.7 trillion. This is what we are obligating KRA to collect from the taxpayers as we service the rest maybe through loans and some elements of grants here and there. If you are to do a comparison, the previous financial year, you'd find that actually KRA met their target. They achieved the 1.6 trillion, which was actually they surpassed a 1.65 and a 1.66 trillion correction. It means they surpassed. And that maybe could be argued because of the expanding the tax base that we saw. However, this year the Finance Act was actually somehow strategic in its approach. Instead of introducing new items, you would find that they were strategic in terms of, let's say, giving more or new definitions, making changes here and there on definitions. And this way you would find that it's actually expanding the tax base through the definitions that were actually provided. You will find some notable changes with regards to terms such as control. Also, it was kind of a reactive way when you see some provisions such as when you are separating the exported services from the exported supplies. This is more of a reactive form where the Finance Act is actually, they are relying on what has been going on. The many cases that you've seen KRA lose with regards to exported services. Also, you will see that we have other changes as much as they are there to cushion the taxpayers for, let's say, when you are looking at how rough the economy has been as a result of the pandemic, you will see some notable provisions such as when you look at the capital allowances, the extension of the time where you could claim your tax losses. These are things that actually are made, and while it's a bill, it's where you have a chance as a taxpayer to contribute, to put your opinion. So we will go deep into the changes. We have the terms such as the control, which has been redefined. Now we are shifting from the shareholding and voting rights only. It's now being extended, and in this way it's intended to actually affect many. The term control has been redefined. Other than the normal one that we know, the voting rights, when you hold at least 20% voting rights in a company, then you shall be deemed to have control. Now we are seeing such a case where it's in case of a loan advanced by a person, if it constitutes at least 70% of the total assets of the other person, this means you shall be deemed to have control. However, this is in exception of financial institutions. Similar case is to guarantorship. A guarantee for indebtedness shall include at least 70% of the total indebtedness of the other person. But this still is an exception of the financial institutions. we have an interesting one where when you do own or at least have the rights, the exclusive rights over the IPs on which other people wholly depended on, this means you will be deemed to be exercising control over the other party. And in this case, businesses that are relying on franchise more are the target in this case. We have with regards to purchases and supplies, where a person supplies at least 90% of the sales to the other person, shall be deemed to have influence on the price and may, in this case, control by extension. Similar is the case for purchases. In this case, what we are seeing is the definition of control is bringing many into the extended, you are bringing more people into other compliance requirements. In this case, the definition of control is actually going to impact the way we view things such as transfer pricing, which is more of a compliance issue. So you realize this is more of a strategic way. We are seeing businesses that are, as I had mentioned, that are relying on franchise, they are going to be affected much by this. On matters of transfer pricing, in a nutshell, which is actually the pricing of the controlled transactions between related parties. In this case, it's between a related Kenyan entity and an unresident related entity. And what we are seeing as an issue here, maybe what we are prospecting, a dispute, unnecessary dispute may arise because it's now at the discretion of the commissioner to determine actually if a transaction is actually independent or it's a related transaction. So these are the things that we are seeing by the redefinition of the term control. We have the redefinition of the term permanent establishment. It shall refer to a fixed place of business where a business is wholly or partly carried on and includes a place of management, a branch, an office, a factory, or a workshop. With regards to construction, it will be a building site, construction, assembly or installation project, or any supervisory activity connected to the site or project. On aggregate of at least 183 days, if the project continues, then you shall be deemed to have created a permanent establishment in the country. We are seeing a new aspect of the service permanent establishment, where the provision of services by a person through employees or other personnel for an aggregate period of at least 91 days in a year, then they shall deem to have a permanent establishment in the country. This, however, includes the consultancy services. So when we are looking at the service permanent establishment, we understand that the country, rather the government, is trying to align the definition of the PE with the international best practice, because it's actually consistent with what is in as per the OECD, their definition of permanent establishment is actually consistent with this, and the aspect of a dependent agent of a person who will act on behalf or in respect of any activities and actually undertakes the habitual concluding of contracts. That is, if you depend on a dependent agent, in this case, they shall actually create a permanent establishment. While you look at it from an extended view, you will understand that this is more of trying to curb the tax avoidance practices that have previously been seen through the permanent establishment definition. So this is where the government is trying actually to comply or act in the best interest as the best international practice. We can relate this to the action plan 7, that is under BEPS, which is an initiative under the OECD. You realize that this is actually the intention, trying to counter or actually tackle those tax avoidance practices through the definition of permanent establishments. So in a nutshell, it will be the risk is actually increased in terms of the crystallizing the permanent establishment to many non-resident businesses. Especially for the service sector, it will be a very difficult affair because now you shall be deemed to have created a permanent establishment in the country. And as I had mentioned, there are more obligations that will come into this. You will be required now to comply. Aside from the withholding tax aspect, now there will be the income tax responsibility. And maybe depending on the nature of your services, you might actually have the VAT obligation being loaded onto your other tax compliance requirements. So those are some of the risks that we are viewing on this. We have the minimum tax exemptions. As much as we understand, the minimum tax provisions are currently suspended, but then we understand the government is adamant on this matter, and introducing new provisions or new exemptions, it means there is more participation by the public with their interest. And this is what I had mentioned. It's good for taxpayers to actually participate, give your contributions when you are addressing the issue of the Finance Act while it's still a bill, so that your opinion actually counts. Via the Finance Act 2021, there is the introduced for exemption, minimum tax shall not apply on persons licensed under the special economic zone. Also, those engaged in the distribution business whose income is wholly based on commission, they shall also be exempted from the same. This is aside from the normal exemptions we've seen, that is in the retail, in the insurance, those people who are under TOT, they are also exempt from minimum tax. And also a new one, it was on those people, actually the big investors, what I mentioned. If you're in the manufacturing and maybe for your cumulative investment actually is at least 10 billion for the last few years, that is 4 or so years, you'll also be exempted from minimum tax exemption. That is a recognition, however, for the big players, that is. What we are having an issue here, or what we need to take note, is when they introduce the word distribution business, it would at least be more relevant or important that it is actually described, because there are other line businesses that offer maybe similar services to but they are not necessarily under distribution business. So as such businesses, we wonder, should they actually be exempted from minimum tax, considering that the provision here is very specific on those whose income is wholly based on commissions. You are looking at people, let's say the bonfire adventures, those people who actually may be the travel agents, such are the people you are looking at. Will we say their business is under distribution? So it's a matter of categorization, and we hope that this matter will actually be addressed. We have the DST. The Finance Act has actually tried to make it clear. And here is where I usually say thank you to the taxpayers who actually make their voices count, because the biggest change under DST, which I will start with, was the relief to many. For onwards, DST shall only be applicable to non-residents. For the residents, this is out of your obligations. It's no more your thing. That is for the influencers and such people. Then the digital marketplace, however, has been redefined. It's no longer just a platform that enables users to sell or buy goods or services. And now it's who maybe provide service or other property to other users using an online platform. This is to mean that there's a high chance any transactions that occur digitally or through any online platform, not necessarily selling or buying, they will actually be obliged or required to comply with the DST regulations. So these are some of the things that we are seeing through the Finance Act 2021. And as I had mentioned, the exemption, now the non-residents are the only ones who are required to comply with the DST. And this is a big picture. The government has seen an opportunity to increase its revenue, so understanding the big players who have no intention of being established within the country, so this is where maybe the government will actually increase its revenues or take a share of those making income out of the country digitally. But take note, it's important to understand that for withholdings, those services subject to withholding tax are actually also exempt from DST. Then we have thin capitalization. Under thin capitalization, the Finance Act was actually shifting us from the balance sheet or the normal way that we've been used to while computing for the deductible interest payments to actually making it equivalent with our business cost, that is the P&L way, the profit and loss way. So the 2021 Finance Act has redefined the thin caps to mean that interest can only be deducted maximum of 30% of EBITDA. Remember, this will be effective starting 1st January 2022. This is to mean currently we are still under the normal provisions which define that interest payments shall be capped proportionate to the total sum of all loans exceeding 3 times the equity, that is the revenue reserves and the share capital. So that shall continue running. So the new provisions under thin cap, it will be subject to EBITDA, and this is to mean the highly geared entities, they are actually going to be affected. The impact will be highly felt on such businesses. The thin cap rules shall actually apply on the following: interest on all loans, payments that are economically equivalent to interest, then any expenses that will be incurred in connection with raising the finance. However, we've seen that they've maintained banks or financial institutions, they will be exempt from these rules, which is a good thing. But there's a new entrant, micro and small enterprises, registered under the Micro and Small Enterprise Act 2012, they will also be exempt from thin cap rules. Having gone through this particular act, the Micro and Small Enterprise Act, you understand that the micro businesses are those that actually have less than 10 people as employees, and their annual turnover is extended to up to 500,000 Kenyan shillings. And the small enterprises are the ones whose income is over 500,000 to 5 million, with the employees ranging from 10 to 50. So if you know you are under that category, that's how the Act actually defines that you are a micro enterprise or a small enterprise respectively. So if you are under that, and maybe you have these plans to get some financial assistance from your related entities outside the country, that is to mean you'll still be exempt. It's a good thing understanding that the government still has the small enterprises at heart. Then we have the additional reporting from multinationals, that's the country by country reporting. The Finance Act 2021 is providing for country by country reporting. In this essence, there is the new aspect of the ultimate parent entity, which it has actually defined this, that it's the parent entity should actually be a company that is resident here in Kenya. It's not controlled by any other company, and it has control, or at least owns, the other entities within the multinational group. In this essence, there will be some rules and regulations that will be provided to determine on what is the accurate information that an ultimate parent entity will be required to declare or reveal to the commissioner with regards to the group financial activities. So this is basically the government is just trying to understand that within a multinational group, that there is no entity within the group that is actually benefiting from the Kenyan perspective, and just to try and curb the tax avoidance that might occur between multinational entities. Then before I go to the tax incentives, while speaking on the country by country reporting, maybe by extension I should comment on the Finance Act that tried to limit the beneficial clause that is under the DTS. That is to mean Kenyan entities that are operating in other countries where Kenya has a DTA with those particular countries, now they will have to demonstrate that the underlying ownership of the other entity in order to benefit any preferential tax rates, or in this case maybe a DTA would provide for exemption or lower tax rates. So for you to actually benefit on that, you will have to prove or demonstrate beyond doubt that indeed you are the beneficial owner, or the underlying ownership for that particular entity is actually a resident in that particular country. You understand, this is actually trying to reveal or trying to control the malpractices that are around the DTAs, where people try to misuse the existence of such DTAs. Then there are the tax incentives. This was a good move through the Finance Act. There is the apprenticeship for engaging interns. Here, we appreciate the fact that initially it was just for graduates from the university. So if you engage at least 10 graduates from universities, you will qualify for a tax rebate for engaging those particular graduates. But then now it's been extended to the TVETs, that is the technical and vocational education and training institutions. So when you engage graduates from those particular institutions, then you do stand a chance to enjoy for these tax rebates. Then we have the equal installments on straight line basis. For capital allowances, now entities will be allowed to claim on a straight line basis. We are moving from the reducing balance basis. Remember in the Tax Amendment Act of 2020 that came into effect in April, the raft changes it brought on the second schedule, that is for the capital allowances. So now it's now a straight line. This is a welcome move in the essence that at least as a taxpayer you stand a chance to gain much or to claim more from the first year of use and the respective periods. Still on the same point, we've seen the aspect of introducing the 100% allowance on investment deduction. Remember, the Tax Laws Amendment Act of 2020, that the first one, the one that occurred in April, it brought a whole raft. It actually changed the whole section, and the maximum allowance was capped to 50% in the first year. But now we've seen the changes being linked to at least for those heavy investors, when you have cumulatively you have over 2 billion in investment, your investment deduction shall stand. Then you remember the ones that were repealed, when you invest at least 250 million outside Nairobi County and Mombasa County, you will still stand a chance to claim 100%. And then understanding the favor that are brought to the SEZs, you are also allowed to claim 100% if your investments are in the SEZs. We have the tax losses carried forward. The period is now indefinite. Initially it was capped to 10 years. We understand this could be maybe to counter the issue of minimum tax, as much as the provisions are actually suspended currently, but this was the intention. Remember, minimum tax did not allow any offsetting in that case. So for your losses, having having them to utilize for until they are all done is a good move. Then we have the investment allowance for electricity producers. These basically are the off-grid people, those who are trying or intending to generate electricity that is privatized, not through the national grid. Now the definition of manufacture will no longer have or limit those people who are using through the national grid. This is to mean that even the private investors, whether you've gotten into the solar business, the ones that are growing up, however small or however large the business is in generating this electricity, then you shall count or qualify to benefit on the investment deductions that are attributable to it. Remember, for manufacturing, there's the 50% allowance on the first year of usage, which is a good thing. Now it will apply to both, not necessarily those who are supplying electricity through the national grid. And maybe this could be argued that it's the agenda or the intention of the government. Remember, Vision 2030 calls that Kenya should be able to meet the demand of electricity supply. So this could be seen as one of the initiatives behind that. Then, as I had mentioned earlier, regarding exemptions from minimum tax, those in the SEZ will now be exempted from minimum tax obligation. Then we have some amendments that were brought through the Tax Procedures Act. Now it will be mandatory for you to have a KRA PIN when you're operating in the digital economy. That is, we understand the intention here, it will be easy for KRA to actually administer the digital service tax regulations with people having through the people who are already having the KRA PINs. We understand people might operate digitally with no intention of even being established here in Kenya, so it might be difficult to track or trace such incomes, and per se, this is actually intended to benefit KRA as much as it's an additional obligation for these non-residents operating in the digital economy. It will now be important, you advise if you know any fella, that they will need to have a KRA PIN. Then, understanding the need for common reporting standards. Basically, this is the framework or the background. We understand there will be regulations that will be released that will define on what is the actual thing that you need to report. This is for those multinational entities. So this is the intention that the TPA now has that clause or provision for common reporting standard obligation. Also, the Act has deleted the provisions which allowed the commissioner to exempt a supplier from withholding VAT if the supplier proves that they are going to be in a continuous credit position. Basically, this is increasing, or rather the government finding ways to achieve its target or generate more revenue. So by now deleting this clause, it means it's an obligation to comply with the withholding VAT obligation or remittance. We have the Employment Act. Here, it was such a welcome move because of the many who actually are not able to enjoy the insurance relief that were paid on this qualifying premiums that were quite maybe high for many. So NHIF contributions will now qualify as insurance relief. Remember, this is effective starting 1st January 2022. This is to mean that for the current payroll that you are having, there is a need for you to be proactive, to understand NHIF contribution will no longer be a tax, will no longer be maybe a statutory deduction, but rather it's going to be a relief. So there's need for you to restructure your payroll in advance. I anticipate for such changes. For those people who have invested in softwares that are managing their payrolls, there's the need for you to configure some things here and there to feature this. Remember, it's mandatory as a Kenyan employer to remit NHIF when you engage employees here in the country. So there's need for you to reconsider. This will no longer be just a statutory deduction, but rather a relief. And then the other advantage, it being a relief, we expect the net pay for many to increase because it's no longer a deduction per se, but it will act as a relief to reduce the taxable amount. However, it will be capped to 5,000 per month or 60,000 per year, no more with the insurance reliefs. Then there were some changes under VAT. Understanding the definition, having stated that digital marketplace will no longer be just a platform that enables users or users to buy or sell services to others through online platform. Now it will be maybe providing services or other property to other users. So there was need for community or rather to be standard across all the acts from the income to the VAT. So the term digital marketplace has to be redefined. Remember, services that are digital platform, they are all subject to VAT. They are vatable transactions. Then we are looking at hiring, leasing, acquisition of passenger cars or buses. Remember, initially the restriction was just on acquisition. Now it has been extended to hiring, meaning that the deduction of input tax on hiring, leasing, or acquisition shall be restricted. In this essence, we understand this is just a way the government is trying to increase its revenues or revenue channels by extending the restriction on deducting input tax from acquisition now to hiring and leasing of this kind of cars, passenger cars or minibuses. This will be a hit to many who are in this kind of sector, understanding we have the taxi people and such. So this is expected to have a hit on them. We expect some pricings to change by rising, not even by reducing. Then we have some items that have been now exempt from 16% to exempt. Understanding the basis here, this actually just increases the level of production. However, when an item is exempt, it means that you cannot claim the input VAT. So from the consumer side, the effect is still zero because you won't actually claim any. We have some of these items such as the food supplements. We have milk in powder. We have food preparations for infants, protein concentrates and such. We have malaria diagnostic kits. Such are the items that will now be exempt, meaning their production is actually enabled compared to the previous moment when it was subject to 16%. However, being exempt does not mean that it actually reduces the pricing or the cost of acquisition, because as a customer, the VAT you can't claim. Some of the services here that are actually now zero rated include transportation of goods originating from Kenya to places outside Kenya, transportation of sugarcane from farms to milling factories, the supply of maize from exempt to zero rated. Zero rating actually, it actually reduces the cost of production as well as the acquisition. As a consumer, you can actually claim the input. So this is a good thing, zero rating this, and the people in the transport sector or of such goods, they are actually going to benefit. And if you can trace, they are more of food stuff and such. So you understand this is more of the agricultural sector that's going to benefit in terms of the transportation of this kind of supplies. Then we have the renewable energy, the VAT exemption on the renewable energy and the extractive sector. Here we have a better interest, especially on the renewable energy, the people in the solar and wind energy. These are the advantage that you are going to get. So starting from the extractive, those goods that are purchased for exclusive use in geothermal, or rather the whole entire extractive industry, that's the mining, exploration and such, now they shall be exempt. Basically, this will actually promote or encourage people to venture into this exploration. Then we have the specialized equipment for generation or development of solar and wind energy. We have things such as it shall include direct current charge controllers, the current inverters. Such are some of the items that will now be exempt from VAT. Then we have the medical equipment that will be exempt from VAT. We understand this is the government still being aware of the situation currently. So you'll find most of these items are in need. Understanding the demand that is in the medical sector currently is quite high, not easily met, and these are the measures that you see they are there to reprieve or to try and remedy us. So medical ventilators, such are the items that will be exempt from VAT. We have breathing appliances. We have weighing machine. You're seeing the supply of denatured ethanol. It will actually be exempt from VAT. This is to favor, let's say, the day-to-day use of sanitizers. Those who have ventured in that business recently, this is your thing to enjoy. However, as much as there is an exemption, this does not mean it's really extended to the consumer, since, as I had mentioned, from the consumer's end, you do not get a chance to claim the inputs for such supplies. It would be more sensible if actually such supplies were zero rated. That is, in our opinion, this is what the government should do in order to counter the medical demand that is on currently. Then for those who had agreements with the government initially, and maybe these agreements provided for exemption of your supplies, these exemptions shall actually continue to stand valid. This is the provision under the Finance Act 2021. So those who had those prior to 25th April 2020, this is your chance. Your exemption shall continue to stand. And we understand, since the outbreak of the pandemic, COVID-19 pandemic, many projects stalled. So this could be one way of the government understanding that the projects, in order for them to actually restart or continue from where they left, it's good that maybe they continue with the exemption status or certificates within the agreements as provided. Then, as I had mentioned in the beginning of the session, the exportation of taxable services to be exempt from VAT. Separating this from the exported supplies, initially it was zero rated, is not really a welcome move in any way. Understanding that many in the service industry, they are going to counter this. Usually, what happens in this case is, it used to be zero rated. You as a supplier, then you would actually maybe lodge for a refund claim here and there. Then, because you would experience challenges determining whether the supply is actually an exported supply, KRA maybe would reject your claim, and then the matter would escalate to maybe to the TAT level, and KRA would lose. And understanding that is the position for many, then it's trying to seal those loopholes where it could be losing more of its money. Seeing this and understanding the many cases that you've seen with regards to exported services, you will find it's a reactive way. When it's a matter at the TAT, you'd find the court making reference to the international practice of determining what is an exported service with the destination principle. But now having these services exempt, it means basically they've done away with that issue, and you won't stand a chance to claim the input VAT that maybe you would now lodge for a claim on it. Then we have some changes under the excise duty. As I had mentioned, the redefinitions, They were actually many, and in one way or another, by extension, they were actually bringing more obligation or extending the tax base indirectly. It was kind of strategic when you compare to the previous act where there were new specific provisions. Now the redefinitions are actually bringing more into the tax net. The term compound shall now has been redefined or assigned to its meaning to communicate any flavor to or to mix any ingredient or material with spirits, but not so as to denature the spirits. That is basically to mean not to change the underlying form of it. So basically they are trying to get clear of what constitutes a compound. Then we have the redefinition of possession, which means having, owning, or controlling any exercisable goods, including having in one's possession any exercisable good, knowingly having any exercisable goods in the actual possession or custody of any other person. In this case, this is actually the one that will be hurting many, introducing the term knowingly, because when one out of any of you that were knowingly the goods in custody or the goods in possession at that moment are actually exercisable goods, it means KRA stands a chance to collect excise tax from you. So we have having an exercisable goods in any place. This may be the warehousing, the godowns and such. Having any exercisable goods for the use or benefit of another person. Basically, it would make so much sense if only they had to clarify that the person who's responsible for remitting excise tax on this service, on these goods, is the person who's licensed to. But then here, the definition leaves the window open. KRA are at the liberty or at their discretion to determine actually who's actually required or supposed to pay the excise tax on these goods. So for people who are in the logistics, the transit industry, they are actually most who are going to be hit because these goods have to be moving from one place to another, and understanding they are just the deliverers, they are not the licensed people. So for that particular period you are found owning maybe such an item, you will be required to remit excise tax if knowingly you knew you had an exercisable product. We have fees or commissions earned in respect of a loan. They will now be subject to excise duty. Basically, they have redefined the term other fees. Remember, the term other fees initially it used to exclude other fees and commissions earned in respect of a loan, to mean they were exempted from excise tax. And this is specifically for the financial institutions. So any other fees or commissions earned in respect of a loan, then it means they will be subject to excise tax. And this is a big thing considering now the definition other fees becomes clear. The only specific items shall remain exempted from excise tax. So the fees and the commissions that are earned in respect of a loan, they will be subject to excise duty. The repercussions basically here means it's going to increase the cost of acquiring these financial services. So that is the way that we view this. And we understand in the previous moments the cases that have been in place, especially with regards to excise duty. The main issue of dispute, or rather bone of dispute, has been defining the other fees. That has been the main source, and many taxpayers could get away, and KRA would lose out on the excise tax that would be payable on such. So when I mentioned it's a reactive way, this is basically KRA trying to seal some loops where it could lose some money here and there. So trying to achieve the 1.7 trillion target, these are the ways that are put in place. And here is where I would recommend there is the need for all the taxpayers. It's good to participate. Give your opinion out there on what you think should stand. Do not let the finance bill translate to an act that's when you raise your issues. These bodies that you are subscribed with, it's important that we utilize them well. Offsetting excise duty paid on internet data services purchased for resale. Now, there will be an allowance for a taxpayer to offset excise duty that is incurred, that is by a licensed person on purchase of bulk internet services for resale purposes. So in this case, when it's for resale, then you will be allowed to offset the excise duty. However, we've all seen the messages maybe from these service providers, maybe Safaricom, Airtel, the telephone and internet data services, they will now be, the excise duty has been increased to 20% from 15% initially. This has already increased the cost of communication. You've seen our charges go up for those service providers, so that has been the direct impact. You've seen communications updating you on your internet costs, your telephone costs. For those internet providers, this has been the case. So the increase has been negatively felt, and understanding these seasons where people recommend working from home, this is going to be a costly affair. Then we have exemption of glass bottles from excise duty. Here, glass bottles will now be exempt from excise duty. They have been subject at 25% initially. This follows a case, if you are to make a reference here, it follows a case, the Kio case, Kio Limited, which is a Tanzanian entity operating in the glass business. They had actually forwarded before the East African Court of Justice that KRA is making the grounds for business, or rather the environment for conducting business, unfavorable. Yet we are in the East African community. It being in Tanzania, it means you can't do business in Kenya. So the 25%, the government considering that it has to play equal with the other entities within the ESE, then this 25% has to be dropped, which is a welcome move for such people or players in the glass industry. Then we have exercisable imports. We have imported potatoes. We have imported onions, imported eggs. The new rate will now be 25%, understanding that this is a way of trying to protect the local market. So the local producers in such items, they stand a chance, since the competition maybe might have been high, but with the new rate, we expect that the local producers to gain a bigger market share compared to those who import. However, we've seen cases here and there regarding such importers of services. They claim, importers of these goods, they claim that as much as the government is doing this maybe to shield the local producers, but the same is not equivalent to what it's doing. Its contribution to maybe the agricultural sector, the quality of these products that are actually to the point that they are imported, it's not at par with what is imported. So there's need for the government also, as much as it's actually shielding the local producer, but it's also working its way out, advancing in its technology just to ensure that the local producers also meet the market standard or requirements. We've seen items such as imported furniture of any kind used in offices. Now is 25% excise tax. However, for this particular provision, for those who follow news, you understand that this provision has actually been suspended because of the ongoing here until it is determined, the hearing is determined. We would say same reference to the Kio case. They need to make the region more profitable in doing business and such. So this could be the backing behind that court proceeding. So there might be a change regarding this, where maybe the 25% will be dropped. We've also seen that there is for those lawmakers, there was actually a difference, or rather differences seen on this provision, that it was not accepted by the committee itself, the Parliament Committee. However, it still got to pass. So there is a high chance that it will be dropped. Understanding the intention is to make business favorable for, especially for those in the East African community. Then we've seen the reintroduction of excise duty on betting and gaming services. This has been brought up to 7.5%. Understanding what we saw through the Finance Act of 2020, the excise duty on betting services was actually abolished. And it has been short-lived. Maybe the practices or maybe the behavior around the betting activities and gaming, maybe they've been on the hike, maybe they've been too much. And understanding excise tax, in this case, the aspect of sin tax comes in. So introducing the rate of 7.5% maybe is trying to control how they are having the effect to the public.